Okay, good afternoon, everyone. We are on week number three. We are on chapter four of the book, and then we'll talk about financial forecasting. So there's an exercise on the PowerPoint slide with regard to how to go to a financial forecast. So what I did was I created the Excel file related to it, and then I'll show you the complexities of financial forecasting. At the same time, I'll give you a alternative on how to compute, how to do financial forecasting using what we learned on week number two on the DIO, DSO, and DPO. So basically, days sales outstanding, days inventory outstanding, and days payable outstanding. So we'll give you an alternative to it that we also use in practice. Like I use the same forecasting method, but I do understand why when we teach it, or most, if not all the books on the topic on financial forecasting will go through a full master data process. Because in theory, you should actually see how it's being forecasted. You would dissect it. But there's another way of doing financial forecasting if you want to do it on an annual basis. So it depends on how complicated or how detailed you want your financial forecasting is. So we will go both on the technical side and the practical side of it. So um, and then I'll post the Excel file for your use on Canvas. So we'll go through it. Let me just move the screen. Now, so why do we do financial forecasting? Financial forecasting is basically used for looking at the growth of a company. So what we have learned so far in our course, we know that accounting is different from finance. We know that accounting is reporting historical information, and we know that finance is actually looking forward on the information used in the financial statements, and then looking at how can we grow the business. What's the feasibility of growth by what type of funding, debt and equity funding. So we're gonna dive into do a deep dive on financial forecasting. So financial forecasting is used on a growth of the company. Um, we use the three financial statements. Basically, we would create financial forecasts for the three financial statements. What are those again? We have the balance sheet, we have the income statement, and then we have the statement of cash flow. So normally, when we talk about the three financial statements, we do it in order, right? We need to create first the income statement in order for us to create the balance sheet, in order for us to create the cash flow. So I would say in the order is the income statement or the profit and loss. And then that will be the balance sheet, the next one. And then the statement of cash flow. So there's a section on the percentage of sales. I'll go through it on a separate video, but for now, we'll go through the calculation on the financial forecast, and then we'll explain the various methods, and then also the process of financial forecast based on seasonality, right? Because depending on the business of the company, there might be seasonality to it. So uh, let's go to the background. Financial forecasting is basically used to plan ahead, and then it's really looking into what are the risks the company has, what are the assumptions that the company looks into as you go through your forecasting year, and then how do you hedge, basically mitigate, offset, or eliminate. I would say risk could not technically be eliminated. Risk can be mitigated. Risk can be reduced, but totally not eliminated. That's why it's called risk management, right? Hedging is actually protecting the company to offset the blow of any risk that it might have. So you were gonna ask me like, what's that kind of risk look like? For example, fuel prices. So fuel prices right now, if you have seen in 2024, it's going down, right? But one point in time, it's all going up. So a lot of companies would open up a hedging instrument, meaning that I'm a fuel company or I'm an airline company. I use jet fuel to fuel the planes. So for example, I'm United Airlines. Or actually, let's take it back. Delta Airlines, in their financial statement, actually has its own refinery. So they would have ample supply of jet fuel or kerosene, right, for jet fuel, in order for them to. So they have a manufacturing, they have a refinery plant that they bought in their audited financials. I forgot which year that I read through it, but that's their hedging strategy. So even if the market is increasing the price of fuel, they have something at stock wherein, okay, I'm not going to buy from a vendor with a high cost that would need me to change the pricing for my customers. I would have a good stock of inventory that's not too high of a cost. That's part of the hedging process. That's risk mitigation on the price of fuel, especially for airlines. So that's what we're talking about. Now, financial forecasting is also used to take a look on, hey, what about those that with no growth, decline in volume? Um, what will happen to the cash balance? So a lot of the forecasting is actually based on three methods, right? Companies would actually have a base case, like a base case. I will just make sure I'll type it in. So a base case would be something we're in. Here's the base case we're in. I'm thinking here's what we're going to land in 2025. Because forecasting, right? So right now in my company, we are starting the budget process. So we are now forecasting for 2025 how is our profit and loss statements going to look like based on the economic indicators of 2024 as of August 2024 or September 2024. So we are creating a base case. Now, of course, the group CFO would say, hey, you know what? That's your base case. But what if the market goes, like the market is better in 2025? So we would have another version, which is the best case or a positive case. But we don't know. So if 2025 will be better compared to 2024, but we have a rendering. We have another set of financial statements, another set of forecasts that shows a best case, right? So we also have what we call a worst case scenario. So what if customers that we have currently right now might not renew their contracts? So we're now looking in 2025 and say, what are the customers that are major that would actually be up for renewal as the contracts? And then we're going to check on the forecast of the market. So we are in the business of selling fuel. We're checking also what's the tourism going to look like? Is it better in 2025, expecting, compared to 2024? Guam, where I am situated right now, relies a lot on the tourism industry coming from Japan and then coming from Korea. Of course, we know in 2024, the yen is very strong, right? Very strong against the US. So it's more expensive for people from Japan to go to Guam and spend in US dollars. So it would not make sense. So they would actually stay. That would mean less Japanese tourists coming to Guam, less Japanese or less tourists spending in Guam. Economy might be sluggish. Now, we do have another set of segments in the Korean market, wherein the won is not as erratic, I would say, for lack of a better term, compared to the Japanese yen in 2024. So the question is, what if in 2025 the tourism industry for, say, the Japanese market would not go to Guam? What is our projection? So we would render a worst case scenario, right? So less tourism in Guam means that less activities by the commercial industry, less hotels having a high occupancy rate. They would consume less fuel from us, and then people who are doing tour agents would consume less fuel. Why? Because they don't have much tourism or fleet buses or bus tours because of lack of like maybe not a strong numbers of tourism. So they would not consume much fuel compared to us. Aviation, maybe there will be a reduction in the number of flights. If they buy from us, they buy fuel from us, then it will be impacting our aviation market. So that's why a lot there's a lot to be said when it comes to forecasting. Forecasting, we will go through it. It might be simple when we go through the exercises, or it might be too complicated in a way, a lot in Excel. But when we do it in practice, we have three sets, and then we always update the three sets. We have a list of assumption by the business segment that we are working with, and then we do the analysis on a per monthly basis, and then we roll the per month to get a full year to date view of the performance for what we are forecasting as a performance for our company in 2025. Not only that, that's basically the budget for next year, right? 2025. We also do a quick forecast for the next 5 years. So we have a detailed assumption and analysis for 2025, the immediate year, and then we would forecast that one for the next 5 years. So we have a immediate budget for next year and a forecast for the next 5 years, which includes 2025. So we can see a strategic view of the business. Do we need more funding? Do we need more funding for capex? Is there a growth that we're looking at? Are we seeing reduction? How do we actually look at the entire business? So that's basically financial forecast. Now, when you think about it, who is responsible for financial forecast? Financial forecast is being done by the finance department or accounting department. Now, the accounting department would use the assumption coming from the operations team. Depending on the segments of the business, they would say, hey, what are you forecasting as your demand? What are you forecasting as supply? Because are you changing the unit price of what we're going to be selling products? Are we actually expecting a change in the vendor price? Maybe the vendor might be charging higher, so the cost of sales will be higher. We might offset it, that increase in cost from the vendor, by changing the selling price of our product. Or we might want to actually, if it's a mature market, that you could not change the unit price of the product, you might need to drive a growth or a higher net income or a higher bottom line by reducing certain operating expenses or being more efficient. So how does it look like when you do the income statement? So all of those assumptions from all the operations departments, you would ask the IT department, sales department, commercial department, the legal department, hey, what are you looking at? HR department, are you hiring more people? Let's include that forecast, and then let me now include a full income statement. So I wanted to give you an idea of what it can be. It can be complicated. It can be simple as well if the operation of the company is not that big, right? But for now, we will go through some calculations on an Excel exercise. Now, we know what's a financial statements. We have a new term, a pro forma financial statement. A pro forma financial statement, using the word pro forma, is a format or a projection of a financial statement. So that's why we use the term pro forma. It's basically a forecast, or here's how it's going to look like, a pro forma. So it would include basically a full balance sheet that includes receivables, forecasted inventory, forecasted payables, and then anticipated profit from the income statement, and then borrowing requirements. Let me include the borrowing requirements. So why do we include a borrowing requirement? If I forecasted an income statement, it means that these are my target income. And then if I targeted an income, it would mean that I targeted also how much are the inventory that I need to acquire if I'm a merchandising company, or the inventory that I need to produce if I'm a manufacturing company. And then from there will be cash movements, buying more inventory or manufacturing more inventory, paying the vendors operating expenses, and then selling them on credit or whatnot. So there will be cash inflow and cash outflow. When you think about it, a company would need to know what is the minimum cash requirement that you need to have each month? Or, for example, let's take a look at it on a personal point of view. As students, you know that, hey, I need to have $500 in my bank account at any given point in time. Or you can say that at the end of each month, I should have enough as $500 because I would need to do work. And then next month, if I get paid again for work, then money will come in. But I would always have a safety stock or a safety stock of cash or like a buffer of cash of $500. So that's why if you are below of that $500 requirement, for example, then it triggers you, oh, I need now to borrow. Same as the company. A company might say have 20,000 or 5,000 per month as their required buffer for cash. Why? Because in the next month, the first 2 weeks of the month, after that, you need to pay already your employees, right? Bi-weekly. And then you're expecting that at the end of the month, say for example, right now it's actually September now, right? So in August 31, I should have $5,000 because by September, say 12, I need to pay my salaries and wages to employees. So in September, I might not be collecting cash yet from what I sold in August. In September 12th, I might not have a, sold a lot of inventory that I would have collected by September 12th, wherein by September 12th, I need now to pay my employees. So you would always have that buffer, say 5,000. So 5,000, 3,000 of it, of which might be your salaries and wages for your employees. Then the rest of the 2,000 might be rent, might be utilities that you would need to pay early after the end of the month. So that's why knowing what is your cash requirement is important. If you think that your cash requirement, you will go below your cash requirement, then you might need to have a borrowing activity, meaning that you would need to borrow from the bank to cover any difference between what you're expecting as a cash balance compared to your minimum cash requirement. Sorry, it's a long answer to one sentence, but I want to make sure that it would actually make sense for everybody, right? Now, also, constructing a pro forma statement is basically used by bankers and other lenders as a guide for the future. So, uh, at one point in time, we actually loaned a big amount from a bank, and the bank asked us, "How does your financial statement look like by the end of the year?" So we always do that. We always throw it up. We always compute our latest estimates. Meaning, for example, latest estimate, I'll explain. It's a term that we use in finance. Right now is actually September. August 2024, we're trying to close right now. By Monday, we closed the books already for our company. So from January 1 to August 31, that's 8 months of 2024, those are actual numbers. From September all the way to December, those will be budgeted numbers because we know the budget, or we did the budget last year, 2024, to forecast, last year, 2023, to forecast the numbers in 2024. So what I can do is that I have a pro forma statement, January to August, 8 months, actual. September, October, November, December, 4 months, forecasted. Even that, I might even update my forecast that was done in 2023 while having it in 2024. There are some recalculation that we need, reforecasting that we need, because the latest estimate is actually different from what we have done back in 2023 as an exercise for a 2024 budget. So those are activities that happens in accounting and in finance. Now, there is a systematic approach, or there's a logic, there's an order on how we develop pro forma statements. First, number one, the most important one, we need to actually do a uh, construct an income statement, we need to know what's the demand, what is the required number of sale, right? Or what's the unit price also. You need to start it off with an income statement. After knowing the income statement, actually, number two and three can be interchangeable, but we'll go with the flow with on our book. You would need to do a cash budget so you can compute the balance sheet. Now, number one is important in technical accounting or finance, and then in practice, the first thing that we do is create a pro forma financial statement. And then from there, we say that, okay, what's the funding? What's the capital expenditure needed for next year? So that's the cash balance because you need to fund it. And then from there, let me now create a balance sheet. So that's the order. We'll go with that order. Income statement, cash balance, and then the balance sheet. Gonna go to the next page. So here is actually how we developed it. I'll explain. Oops, sorry. Number one, we do the pro forma income statement, and then we do the cash balance. We can create now a pro forma balance sheet. Now, you would see, why do I have the prior year balance sheet? So remember the balance sheet, as we talked about in week number one, the balance sheet is basically as of a given date. It's the ending balance as of a given date. The prior balance sheet uses beginning balance for the current year. Ending balance is our current balance sheet. That's why you might need to use the prior year balance sheet as the reference. And then also, if we are doing, let me just change the color. If we're doing the pro forma income statement, you need to understand the production plan. The production plan, so it starts with the sale. Income statement, the first line is sales or revenue. Sales or revenue consists of two things, the unit price and the quantity to be sold. If you know the sales projection, then you can multiply it with the unit price. I'll just say unit price is UP. And then now you would actually have sales. What's the next item in the income statement? It's cost of sales. So remember that sales less cost of sales is actually gross profit, right? Gross profit. So I'm just gonna write it down like that. So gross profit. So sales projection coming from here, production plan is the cost of sales. So why production plan? I can produce something right now to be sold the same year, but I might have inventory prior to 2024 that I'm going to be set. So basically, the ending balance of inventory in 2023 December that is carried over in 2024 will be the first item that I would sell in 2024. So I should not produce all the quantity based on the forecast. Let me repeat it. Let me repeat that logic, right? If you're thinking about selling 1,000 quantities or units of items this year, so the question is that, do I need to produce 1,000 to be sold throughout 2024? Or do I have inventory from last year? Say if you have inventory units from last year of 200 units, it means that I only need to produce 800 this year in order for me to sell the 1,000 sales that's actually forecasted this year. So simple enough, right? But let's add one more layer. At the same time, even though I have 200 from last year, then I need to produce 800 this year to come up and satisfy the sales forecast of 1,000 this year. I know that I need to have an ending inventory just to be sure that I have a buffer, right? So it might be 300. So I have 1,000 of demand forecasted in 2024. 200 comes from last year, 800 to be produced this year to satisfy the 1,000. But if I think I need 300 as ending inventory, then it means that it will be 800 plus the ending inventory of 300. So it's 1100 that I would need to actually produce this year because I need to have an ending inventory. So you would ask me, sir, why do we need an ending inventory? So imagine it this way. As of December 31, 2024, if you do not have any ending inventory, meaning that you're just producing as needed, right? You might have a lead time before you can manufacture something. So by January 1 of 2025 or the first week of January, the people are still on vacation mode. Maybe they're not, your production line is not working, but consumers are buying your goods. So if you don't have an ending inventory as of December year end, it means that you have nothing to sell at the beginning of the year 2025, the first week. That's why you would always have a buffer stock or a stock buffer or a buffer of inventory. That's why you always have an ending inventory, just to be sure that concept wise, we would actually see that. So if you have not seen it, accounting and finance is all about logic when it comes to understanding how the business works. And let me now put that logic with some numbers and let me document it in some form or fashion. Then we call that accounting. Or we need to report it in some form or fashion that will be understood by everybody from the CEO, the CFO, the chief operating officer, the chief executive officer, or the chief financial officer. So, or the senior management team or the bankers. So that's basically what accountants and then finance people do. Basically telling a story and reporting it, how it's actually looking like your financial health. Now, we're going to go through some of the items. We're going to start now with our income statement. Now, pro forma income statement, we provide projections on anticipated profits over a subsequent period. It can be, so the exercise that we're going to do, we'll try to do it on, I think, 6 months only. Um, but you normally do it in 12 months and it rolls up into 1 year, right? The most important steps on doing the income statement. Remember, first step is the income statement. What's important on the income statement? Let's now do the projection. If we know how much we need to sell, we would now need to determine the production schedule. Why? Because we need to consider beginning balances of inventory. And then from there, we need to say, hey, how much is the cost of materials, labor, and overhead with regard to what I'm going to be producing, and then the anticipated gross profit. What's gross profit again? Is actually sales minus cost of sales. And then we will compute the other expenses. What's other expenses? Income statement means sales minus cost of sales equals gross profit minus operating expenses, which can be general and admin, selling and marketing. That will be operating profit before taxes. And then we will compute the profit by completing the actual pro forma financial statement. Now, I would actually go here and then I would pause the video and then we will do another video. So just to give you the first video that I'm posting right now is actually just an understanding or an overview of the business. Then we will do another video that's purely Excel calculation. So be ready to, you can open the Excel file that I'll be sending out, or the best way will be just to walk you through it, focus on the Excel file, and then after that one, jump in and then try to see how the calculation works. So before we end this video, I'm just going to do a prelude, right? We're going to be looking at Goldman Corporation. It actually has two types of items that's being sold, wheels and then casters. So the wheels here and then the casters, we have the quantity multiplied by the sales price That's the revenue. We're looking at a revenue as of June 30, 2022. So that's our date for 6 months of 2022 as 100,000. So I'll end this video and then we will go to the next. But when we open it up, it's going to be all Excel, and I'll load the Excel also in our Canvas. Okay, so I'm going to stop here and then we'll see each other on the other video. Thank